5 formulas every trader needs to know. I'm Manir, also known as Ghost Dog Trades, and I also run unbiased trading. Let's get into these 5 formulas that you really should know. First is the Sharpie Ratio. The Sharpie Ratio is used to evaluate the performance of a strategy by adjusting for the risk taken. It is the cornerstone for strategy comparison and should be used by every trader to gauge backtests. The key takeaway of this one is the higher the Sharpie ratio, generally it indicates a better strategy adjusted for risk. Now, personally, for a while, I really thought Sortino ratio was a lot better than Sharpie ratio. If you're unaware of the difference, Sortino ratio doesn't compensate for any positive volatility. So meaning if the trade went from like 1,000 plus down to 500, it wouldn't be compensating for that because it's only looking for the downside risk, which would be conventionally what most investors are actually focused on. However, when I was looking further into it, just overall, the statistical significance of the Sharpie ratio is a lot stronger than the Sortino ratio, and there are some particular flaws with the Sortino ratio, maybe limiting the amount of samples, which can then affect the actual significance of that particular ratio. So it's still just a debate overall. I think both people have different sides of it, but personally for me, the Sharpie ratio is a lot more important than the Sortino ratio. But if you're using either one, I would say that's better than not using any of them. And I know for some people using kind of like even some of these kind of formulas is very new to them, at least in the trading sense of things when backtesting. So make sure to focus on the Sharpie ratio, make sure to do some extra research on it, and that will be a key metric that you'll be focusing on if you're doing backtesting of a particular strategy. And also it's an amazing way to just compare strategies, as it's pretty much on all strategy results tables or performance metrics. Next is the risk to reward. So this formula is all about balance, in my opinion. It tells you how much potential profit you can make compared to the risk you're taking on each trade. That doesn't obviously have to be potential profit. That's if you're doing like a trade that you're about to place. But if you're doing it historically, then it's just the profit you're making per the amount of risk on that trade. For example, you could be risking $10 to make $30, which translates into a 3-to-1 risk to reward ratio. Now, while a high ratio isn't really a magic bullet that's going to make you instantly profitable, it can help you be more selective and avoid risky bets, which are only 1-to-1, or, if you're going below 1-to-1, it's very difficult to make a profitable strategy, in my opinion. But normally 1-to-1 is still quite achievable. Now, the key takeaway here is aim for a risk to reward ratio that aligns with your risk tolerance and your trading style in general, but it isn't needed for you to actually be profitable. The reason for that is risk to reward compared to win ratio are basically in equilibrium, which means if you had a 70% win rate and you had a 1-to-1 risk to reward, so you're just making the one amount of risk basically for every trade, then you're still going to be profitable because you have a 70% win rate. Whereas if you have a 4-to-1 and you have like a 30% win rate, you would still be profitable as well. So they do come with differences. The main difference, in my opinion, is when you have a stronger win rate, you're going to have lower volatility and your drawdowns are going to be a lower amount of time because you have a stronger win rate. Whereas when you have higher risk to reward, but you have a lower win rate, you're going to be in drawdowns for a longer period of time because you're waiting for that one trade that gives you 5-to-1 risk to reward and recoups a lot of your losses from before. At least mentally on a trader, even if you're doing this algorithmically, I think the second method definitely pulls a bigger amount on mental capital and sometimes can be hard to actually go through and stick to. It's easy in theory, and when you look at a back test, hey, look, the average drawdown was 20 days. That's fine. I could be fine waiting 20 days to get out of a drawdown. But when you actually get to it, it's a whole different lesson. It's a different thing to it, really. If you can cope with that, then really, high risk to reward and low win rate is still a perfect formula to be profitable. And I know a couple of traders that are really good at it. So don't, push off a strategy just because it has a low win rate and a high risk to reward, but just be aware of how your risk tolerances work. At least for me, no way I could really do that. I've tested it before. I failed every time. Now I could probably train myself over a year or two to get better at that, but I can just focus on these other strategies that have already been profitable for me, and that's an easier way to actually get to profitability compared to trying to rewire or improve my mental like that for a whole year or two. Now, obviously, this is just my opinion, but risk to reward is still a key formula you need to be aware of. Next is standard deviation. This formula is the core to hundreds of indicators, as it's one of the best measures of volatility out there, making it great for mean reversion type of strategies, and be sure to use it to its fullest potential. Now, the key takeaway for standard deviation is that it allows you to assess volatility and identify potential mean reversion opportunities, and it is also a great one you can tag into pretty much any indicator of your choosing. If you're unaware of what standard deviation is, you're just measuring the volatility within a particular data set compared to the mean. So the mean is just the average. So if you had, an average of 50 and the standard deviation was like 20, that's actually quite high on that kind of standard deviation sides. And we also have multiple standard deviations. You could have standard deviation to 1 to 2 to 3, and those are just basically adding on that standard deviation onto that mean or whatever number you're looking at. So this can be really useful. A common way people use it is standard deviation VWAP bands. People sometimes just use the standard deviation as an indicator as well. I've personally done actually a whole strategy kind of around that. I think I'll try and release that on Twitter or as a YouTube video at some point because it's a really basic idea, but it works decently well. Obviously, it's not the golden strategy, but it's still a really cool method of using it, and it really describes how powerful standard deviation can be. So be sure to check this one out and be sure to apply it to whatever data sets you're looking into, and sometimes even the indicators that you're using, because you'll be surprised how normally if you just slap on 2 extra standard deviation, your mean reversions can be a lot more precise. Now that's not in all cases making the strategy more profitable, but it does make it more selective, and often the entries are normally better, at least from my experience. Next is maximum adverse excursion. Now, big losses can sting. The MAE formula helps you gauge the maximum potential loss while your trade is open. Now, by analyzing your MAE, you can see if you're entering trades too early or taking excessive risk. Even small adjustments on this can make a big difference in protecting your capital and actually even in your profits. The key takeaway for MAE is it helps you analyze potential drawdowns and refine your entry timing and risk management overall. For a while, I was entering trades way too early on one of my particular strategies, and by using MAE, I really was able to identify that. Realistically, I was entering, I think, about $600, which was on 2 contracts too early. I tried just entering after normally when I would normally enter, and that really did improve performance. Now be careful, this is a really easy way to overfit your strategy. If you're not doing out of sample testing, this is such an easy way to overfit, and I see a lot of people do it because it makes sense, it definitely does, but when you're not testing it on a new data set or a new chunk of time you haven't optimized on, it's very easy to just be picking the best number basically on that data set. So be careful when using this formula, but it's still a great formula, and it really is one of the best ones to improve your entries overall. Next is compound annual growth rate. Now, absolute returns are commonly used by traders, but it doesn't actually provide a fully accurate picture of the returns. Instead, compounded annual growth rate shows us the annualized rate of return, including compounding, giving us a clearer picture by addressing outlying years. The key takeaway for CAGR is it allows you to assess returns and compare strategies objectively compared to just looking at the total return. The reason for this is a common issue sometimes with some strategies is you can have outlier years that make up the majority of your returns. So let's say 2020, you made, 500%, and all the rest of the years you only made 10%. Your total returns will look amazing because it'll be 550, let's say. But that 500% pretty much only came from one outlier year, and it doesn't actually show that the strategy is very consistent or reliable. So taking into your CAGR, you can actually see, okay, on average, each year, it compounds about 20%, 30%. And that gives you a lot of a clearer picture compared to that 550, for example. Now, obviously, in that case, I'd still be worried because I wouldn't want any strategy to just have one outlier year where it completely toppled all other returns, unless the returns were somewhat consistent in the other years as well, and that outlier year just had really good conditions for that strategy. But in these other years, it still performed really well and up to my expectations. Now, if you want to learn even more about mathematical concepts in trading, please check out my previous video. I went over 4 mathematical concepts you really need to know. I got 1,000 views really quickly, so I was surprised you guys really enjoyed that video, but be sure to check it out if you enjoyed this one as well and you haven't checked it out before. Now, these 5 key formulas are often necessities in trading, and without them, you'll be missing key statistics. So be sure to note these down and use them into your own back testing, performance metrics, or in your own trading. Thank you for watching, and if you enjoyed it, please like it and share it with anyone else who might be interested.